Hey guys, this is Dan, and today we're going to be looking at the mathematics necessary for investment, all right? And by mathematics, I mean we're going to put Excel to do our work for us, and we're going to just sit back and enjoy our rent. So remember, this is a continuation from the last video where we actually bought an apartment using a mortgage and used Excel financial formulas to calculate how much that mortgage would actually cost us, all right? And figure out the structure of the loan. Now, after we bought that apartment, the original idea was to rent out that apartment and see if we could make some money renting it out and actually beat the bank, make some money in the end after the 15-year mortgage, all right? So this is pretty much the oldest get rich slow scheme in the book, and it actually works, all right? Spoiler alert. Spoiler alert. Yeah, it's going to work. All right, guys. So let's get started. If you remember, last time we bought out the apartment in one of the poshest areas in the city where I live in, Guadalajara. And notice how it's right next to the country club. It's right next to the Colomos forest, and everything right here is just bristling with activity. All sort of hipster shops and offices, high rises, stuff like that. All right, so it's pretty much you can't get any better than this. It's equivalent of having I don't know, waterfront property in Seattle, or Seattle's pretty much the only American city I know. Okay, so back here we have an analysis, a quick back of the envelope analysis that I made to figure out how much money we could expect from a property, all right? So figure out how much money we could expect from a property. So two sources of income for homeowners. First one is rentals, all right? We can expect actual cold hard cash coming into our pockets every single month from the poor, hapless sop that actually rents out our property, all right? So that's pretty attractive because that's actual money that's coming into us. But remember, there's another second source of income that we don't usually take into account, and that's our property appreciation. Remember that when you buy property, barring any unforeseen events, that property raises its value, all right? That property goes up in value, always, no exceptions. Well, anybody who lived through the 2008 financial crisis will know that is not true. All right, guys, there are some unforeseen circumstances that can actually make that not true. Number one is if you get imposed a communist dictatorship in your country, you're screwed. That property is going to be worthless. Ask the people from Venezuela. All right. Number two, the actual neighborhood that you're in, it gets screwed by government intervention, whatever, low lives moving. I don't know. The neighborhood can actually go down. The particular neighborhood can actually go down in value, even though the rest of the city is actually going up. That's pretty sucky. That's like you notice it's only raining exactly on where you're standing at. All right, and reason number three why property values go down, I don't know, some unforeseen disaster, an earthquake, tornado, whatever, destroys your house, property is now worth zero, all right? I'm not going to go into why the 2008 crisis happened, that was something different, but my point is, it's a pretty safe investment. Now, considering that the investment is going to be pretty safe, we need to figure out how much it's going to be generating for us. There's several ways to go about that, but notice that I have here a map which is pretty similar to the one where we bought. Several rental properties that I found that are renting out for different prices, all right? Now, the prices are right here in pesos, and for the benefit of my international audience, I converted to dollars, all right? So, say, for example, this apartment, which is pretty much the same amount of square footage, is renting itself out for $2,000. Whereas this one, which is also pretty much in the neighborhood of square footage, is renting itself out for $1,500, all right? So we can pick and choose. I mean, if we're going to be forecasting how much money we're going to be making in rentals, we can pick and choose from here, all right? I'm going to be pretty conservative here. And pick the low end. I like this one, $1,575. $1,575. So, starting value of the property, it's $250,000, $260,000. Transaction costs. Remember, that is going to be how much the bank charges us to valuate the home, and then the legal fees the lawyer charges us to shuffle some paperwork around and say, by the power vested in me, you are now magically the owner of this apartment, all right? I hate lawyers. All right, so the expected rent right here, it's there's no scientific way to go about it. I'm just going to say let's low end based on what the market rate is. So low end is going to be $1,575. I'm going to get conservative with that. Now, since we're talking about investments, inflation, it's always going to rear its old ugly head. And yes, we need to take that into account. Now, this investment is going to be good for 15 years because after that, I'm going to finish paying off the mortgage, and I can choose if I can sell off my apartment to buy a bigger one or just keep it and keep it renting it out, right? So, last thing that I need to do is the expected final value of the apartment, and this is pretty much an exercise in guesswork. I mean, you could call it forecasting and be scientific about it, but in the end, it's just going to be guesswork. All right, so the best I could do is I scrunched up a newspaper article that, for those of you that don't speak Spanish, I translated it for you here. Too long, didn't read, pretty much says that property values tripled in the city in the last 10 years. Some places they went up by even more. Providencia, I mean, this neighborhood was one of those places where property values more than tripled. But that gives me an estimate of what I can expect in the next 15 years. So I'm going to be pretty conservative here and pluck a number out of thin air. If property values tripled in 10 years, I'm going to say that in the next 15 years, I'm going to expect them to go up by about, say, 2.25 times. Why 2.25? I just plucked the number out of thin air. I mean, that barely beats inflation. So I'm going to grab the starting value and multiply it by 2.25. Notice how conservative I'm being. History says property values triple in 10 years. I'm saying it's going to barely more than double in 15 years, all right? So I'm not being aggressive on this. I'm just saying that the expected final value of my apartment is going to be $585,000 down the end of the road, all right? Down the end of the road. Plus whatever it nets me in rents, all right? Whatever it nets me in rents. Now, guys, we're all ready to start. We're going to be pretty much doing something similar to amortization table from last exercise, but it's going to be a little different. In this case, we're going to be evaluating the asset as it appreciates slowly, and calculating how much cash flow we're generating. Cash flow is the wrong word because that pretty much means only the money that's coming in, and we also want the appreciation, which is not actual cash. It's just an imaginary valuation of our home that goes up and up and up forever. All right, so the total, say, for example, incomes, all right? This makes more sense. Total incomes. All right, so for starters, we need to translate this to stuff that Excel can use, all right? Stuff that Excel can use. So total number of months. Remember, since we're calculating this on a monthly basis, because rents are paid on a monthly basis, we need to calculate the total number of months. All right, total number of months is going to be this one times 180. All right, guys? What the hell? No, I'm sorry. This one times 12. All right. Rate of property value growth. Now, this is interesting. We have to figure out how much it grew every month to get from this starting value to this final value. Now, you have two choices for this. You can use your complicated and fancy financial math that you learned in business school, or you can use one very simple Excel formula. Remember, we already checked that one out in the last video. If we want to know an interest rate or a rate of growth or whatever, we get this nifty formula called rate in Excel, all right? Now let's go check it out. The number of periods are going to be, well, 180. Payment. We have to figure out how much our property is appreciating, but we're not actually paying anything into a property for it to appreciate. I mean, it's just something that we sit on it, and its price goes up and up and up and up steadily, all right? That's one of the benefits of being a capitalist landowner. So I'm going to just press 0 on payment. Now, the present value is how much the property was worth at the beginning of the period, $260,000. But we're still not ready because we're going to need the future value. Future value, property is going to be worth $585,000. All right, guys, $585,000. And now I think we are almost good to go. Notice how when I press OK, this is going to happen. Error, all right? Why? Because Excel isn't happy with my numbers. I'm sorry, Excel isn't happy with my numbers. Remember how I kept telling you about how the plus and minus signs are pretty important in financial math, especially if you're using financial formulas? Well, this is pretty much the case, all right? This is pretty much the case. Excel wants my present value to be an outlay because I'm actually paying for the property, and my future value to be an inlay because I don't know, I'm going to be selling the property and receiving money, or I'm just going to evaluate and see it's worth now $500,000 and feel rich about it. I don't know. But the point is, one needs to be negative and the other one needs to be positive. And now we get a return, all right? Now we get a rate of return. Really important that you keep this in mind, all right? We always need cash flows to be negative on one end and positive on the other. Press OK on that and we get the rate of property value growth is going to be 0.45% every month, all right? Every month. Now, this is pretty intense. It's pretty awesome. There are some guys that do day trading. They can't get to this rate of return. Actually, they lose most of their money. All right, so let's go over to a monthly rental rate. Monthly rental rate is pretty much the expected rent, all right? But we need to calculate it as a function of the starting value of the property, all right? So it's actually going to be more like 0.606%, all right? We're going to be receiving 0.60% of our property value in rent every month. And finally, the inflation rate. Well, it's pretty much the inflation rate divided by 12. There we go, monthly inflation rate. Notice how the rate of property value growth barely beats the inflation rate. That's how conservative we actually got, right? That's how conservative we are actually being. All right, guys, so now let's calculate everything. Now, remember, our property is going to appreciate, which means we can raise rents every year. All right, we can raise rents as our property appreciates. So that means we're not going to be charging $1,500 in rent in the future. We're going to be charging way so much more. And since our property is going to be appreciating, that means we're going to get a ton of money and a ton of additional money. So the starting value of the asset is $260,000. That's our initial value. Our initial rent is going to be the value of the asset multiplied times the monthly rental rate. And since the monthly rental rate is going to be always the same, I am going to just do an absolute reference on the monthly rental rate, right? Now, how much is it going to appreciate for the month? Well, it's going to be the value of the asset. It's going to be the value of the asset times the rate of property value growth, all right? The rate of appreciation. So we're going to be receiving $1,500 in cold hard cash in the first month, and we are going to use our imagination to imagine that our property is now worth $1,000 more and we're $1,000 richer, all right? So the total incomes for the month are actually going to be this one's $2,700, and the value of the asset next month is going to be starting value plus whatever it appreciated last month. Now, why do I keep using the word imagination around here? Because appreciation doesn't work that way. It's not as if you could buy the property 1 month and then expect to sell it the next month at $1,000 profit. Maybe it works that way. I mean, I'm not sure what neighborhood you're in, but remember, there's this little fella right here, transaction costs, all right? You have to wait to make at least $20,000 before you can actually turn a very tiny profit on this, all right? Because you already paid $20,000 on the valuation and legal fees to get the property bought, right? So whatever, it doesn't matter. Rent, I can drag it down like so, as well as appreciation and total incomes. And this second line is good to go for me to drag it all the way down here to line 180, all right? Line 180. Now, notice that at the very end, the value of the asset should be pretty much this one, all right? But we get that the value of the asset is $582,000. Why? Because it's the value of the asset at the end of the period. We start out at $582,000 plus the appreciation for the month, and then we get our $585,000, all right? So that's proof that we did our calculations correctly. That is proof that we did our calculations correctly. We are good to go. Now, then we should get our total cash flow from rent. Total cash flow from rent is the sum of all the rents. And total property appreciation is the sum of all the appreciations, all right? All the appreciation incomes. All right, so now let's get a little bit more realistic with this, okay? Let's get a little bit more realistic with this. Why? What do I mean by realistic? Well, for starters, I'm not going to be able to raise rent on my tenants every single month, all right? I'm going to run into a bunch of laws, housing department, stuff like that. That's going to charge me for, they're going to put me in jail. It's not legal for you to raise rent every single month on your tenants. You have to sign a contract, and that contract has to be worth like for at least 12 months, I think, and then you can raise rent after that contract expires, all right? So this total cash flow from rent, it's imaginary, it's not real. We have to adjust it for the fact that we're going to be charging some rent at the beginning and then adjusting it at the very end. And fixing that is actually pretty simple, all right? We have to go over into our second line. First line is fine, all right? Second line, how are we going to fix it? All right, we're going to be doing the following. If mod this number plus 1, this number minus 1 divided by 12 equals 0, then we calculate the rent as we were calculating it originally. The value of the asset times the rental rate. Otherwise, we just grabbed last month's rent, all right? Now, what did I do here? It seems like a complicated Excel formula, but it's not, all right? What I did for starters was I created a logical function called if, that is going to test out if we are changing years or not, all right? This is the formula that tests if we're changing years or not. If we're changing years, then it calculates the new rent. If we're not changing years, then it just grabs last month's rents and charges the same amount as last month's rent, all right? Now, how am I figuring out if we are changing years or not? Well, I'm using this mod formula, all right? This mod formula, what it does is it gives me the residual of a division. So what I'm asking it is checking out, say, if we divide 5 by 12, is it a possible division? No, we get a residual. If we divide 12 by 12, is it a perfect division? Yes, because 12 actually fits in 12. When it actually finds out there's no residual, the residual is equal to 0, well, then we are changing years and we can adjust the rent upwards, right? So let's press OK, let's drag this down, and notice how I get the same amount of rent all the way until month 12, and in month 13 we adjust it upwards, all right? And then in month 25, which is the start of the third year, we adjust it upwards. And in month 37, which is the start of the fourth year, we adjust it upwards, and so on, and so on, and so on. That way, this is far more realistic, and of course we lost money on the deal, but we're covered from a legal standpoint. So notice how we were originally predicting $436,000, but after my modifications to make sure that we charge same rent every month for 1 year, in 1 year periods, we're actually going to be getting $425,000, all right? It's not that much that we're losing. 10 grand sounds like much, but viewed in the context of the numbers we're looking at right here. All right, guys? So, the total final value of this asset, is going to be the sum of its cash flow and its property appreciation and, its starting value. So, it's going to be the starting value plus the total cash flow plus property appreciation. And we are going to be making $1 million on this investment, and that sounds awesome, all right? For doing nothing other than just buying the mortgage and, buying the apartment with mortgage and renting it out. And of course, this is unrealistic because it assumes it's always going to be rented out and you're not spending anything on renewals or, maintenance, stuff like that, all right? But it seems pretty awesome from this standpoint. The total final value is $1 million. How much were we paying to get this apartment? Well, remember back here, we were actually paying the sum of total payments, $486,000. So it seems pretty good from an initial standpoint. And it is going to be pretty good. But remember that we have our little friend here called inflation, and we cannot just leave it out, all right? Yes, it's going to be $1 million nominal dollars that we're making at the end of the period. $1 million nominal dollars. But remember, inflation makes your money worth less and less and less and less. So, at the end of the period, even though we've adjusted the rent upwards, inflation is going to make our rent buy less and less and less and less every month. Our incomes from the rent are going to be buying less every month. Same thing goes for appreciation. And even though our apartment is worth a little bit more, it's worth more than double at the end of the period, remember, inflation is going to make it seem as if it is worth less, because remember, prices for everything go up every single year, right? Every single month, actually. So what we have to do is take that into account and include it into our calculations, And that is the reason we have this nifty little tool here called net present value. Net present value, what it does is it grabs a series of cash flows or incomes, and it brings them back. Discounts them at whatever rate we want, in this case the rate of inflation, and gives us how much this asset is actually going to be worth to us right now after we've discounted inflation, all right? Or, built for another way, right now before inflation effects take effect, all right? I'm sorry for the word repeating. All right, guys, so what I'm going to be doing here with net present value is just going to be grabbing the total incomes. Which is the sum of rent and appreciation, and I'm going to remove my my title, and I'm going to include the outlays here. So how much is this asset going to be worth for us at the very end? Well, the outlays here are the transaction costs, and you need to make sure that those are negative, all right? Those are negative. So here's one way we could do net present value of the asset. The calculation by hand, with using your fancy financial mathematical formulas, it's pretty damn complicated. But when you come here and use an Excel formula, it's so simple, it boggles the mind, all right? MPV, we open parenthesis, and this is it, all right? What's it asking for us? Well, the rate, which in this case is a monthly inflation rate, and the value, which is actually a list of values, a list of cash inflows and outflows that we can use, all right? A list of cash inflows and outflows that we can use. All right. And this is actually the money that we're going to be making on our investment, all right? This is actually the money that we're going to be making on our investment. Now, it doesn't seem like much, but remember, this doesn't include the starting value of the investment. So we add this up with how much the apartment was worth at the beginning of the period, and there we go. Now, this looks this looks far more reasonable to us, that even though we include inflation, we're still going to make a ton of money, $750,000 once we include inflation. And we also need the internal rate of return. The internal rate of return is going to be pretty much how much, what's the rate that we can expect? What's the rate that we can expect from actually performing this investment, all right? All right? So, internal rate of return, the formula is going to be IR. All right, and the values are pretty much going to be the same. And notice that we get something ridiculous, 14% a month, right? 14% monthly, that is absurd. So what I actually need to do here is figure out the outlay, minus $260,000 at the very beginning of the period, at the very beginning of the cash flow. And now we get something that makes far more sense. 1.12% we're going to be doing monthly on this investment. All right, that's the internal rate of return in the investment. Now, net present value and internal rate of return, they're semi-advanced concepts in finance, and they merit videos on their own. All right, But right now, you could be like a finance 101 neophyte, and you could already start talking about net present value, which is the value of a series of cash flows discounted for something. I don't know. Discounted at the inflation rate, the risk-free rate of bonds. I don't know. You can discount them at whatever. That's something that we're going to be talking about in further videos about finance, actually. And the internal rate of return is you get a bunch of cash flows, and it tells you how much, if you're paying $260,000 right now, how much you can expect to get in return. All right. Now, what would we go about comparing right here against the mortgage? Well, there's always we can compare the mortgage and figure out it's a better investment, all right? We can compare our $1 million against the $186,000 that we would be paying back to the bank. Why are these comparisons correct? Well, because this $486,000, they do not include inflation. Neither do this $1 million. So we're good on that. We won on that. All right, we could compare this $740,000 against this $341,000. Again, we won on that. We won on that account as well, because these two, they include inflation, and we're still winning by a lot. All right. I'm sorry. And finally, we could compare the internal rate of return against the monthly rate the bank is charging us. Right. The internal rate of return 1.12% against 0.94% every month. Remember, it doesn't look like much of a difference. I mean, these numbers, they don't look like much of a difference, but remember that this is compound interest and it's compounded every month. So that leads to us making twice as much money as we would have made out with the bank. I mean, twice as much money as the bank charged us in the first place, all right? So guys, why isn't everybody doing this? I mean, why, if this is such a surefire way to make money, why isn't everybody doing this? All right, because the rent that you're charging does not cover the total payment amount. So you need to charge rent for your apartment and still grab some money from out of your pocket and put it towards the total payment amount. All right, it's not a free lunch. There's no such thing as a free lunch in finance. So a lot of people, they'd actually need to. A lot of people actually think, oh, I'll just buy a house using a mortgage and rent it out, and the two will compensate themselves, and I'll make myself rich. No, it doesn't work that way. Banks know that. Banks know how that works. They're not in the business of making you rich. They're in the business of lending you money. But they're going to charge as much as makes sense to them in order for them to make money and still get customers. And the rent that you're charging out for the apartment, it's not going to cover that amount, all right? So you need to be putting out money from your own pocket, from your own savings, from your own salary, in order to compensate for this difference. Eventually, the rent is going to go up so much, thanks to inflation, and the total payment is going to remain the same, that the rent is going to overtake the total payment. But don't count on that. That is literally going to happen in month 121. That is the start of year 11. That is the start of year 11, all right? You're going to be putting out cash from your own pocket for 10 years. And you're going to say, all right, but what about the appreciation? Remember, that's imaginary money. That is not going to be realized in your pocket until you sell the asset, until you sell the apartment, all right? So this is just imaginary money that is going to help us raise the rent, and it's going to be actual cold hard cash for us once we sell the asset. And remember, all of this is a prediction, all right? It's just forecasting based on real numbers, if you want, based on real information, but it's just forecasting. Anything could happen. Whereas the amortization table for the loan, this is a sure thing. You can be sure that the bank is going to come around the sure spring and charge you every single month for your payment. And this is set in stone. Well, in legal contracts, but still, it's going to happen the way we're describing it here. Whereas this one, it's a forecast. Things may not pan out. Remember, as I said, you could get a communist dictatorship installed in your country. You could get a natural disaster and lose your home. You could, the neighborhood could go sour. I don't know, the city, something could happen with the city. You could get any number of reasons why this doesn't pan out. It's usually pretty safe, and it's almost a surefire way to make money, but again, it's not exactly foolproof, all right? And nothing I say should be construed as financial advice, all right? It's just an Excel exercise to demonstrate financial formulas. All right, guys. So with that done, I think we've covered pretty much everything that we needed to cover. Financial math in Excel, as you can see, is pretty easy, and finance in general is pretty easy. It's just a matter of figuring out how much getting the money is going to cost you. If you get it from your grandma's pension fund, it's going to be pretty much free. And how much is it going to make you when you put it to work? All right, and remember, how much is it going to make you? That's just forecasting, guesswork. All right, you can make it as scientific as possible, but it's never going to be foolproof. All right, guys, I hope you enjoyed the video. Would really help me out if you subscribed and left your comment here saying, I love the video, I hated the video. Just let me know what you thought about it. And if you want to see another video about something, make sure you leave it in the comment. If I find it interesting, you can be sure I'll make a video about your topic.